Coming up in this show, I'm going to bring you my opening comments on the markets. Arby has stock sectors, analysis of sector ETFs using our market condition indicator. Katie will bring trade planning with options. She has an option trade up in light crude. And then I'm going to bring you my analysis on the stock market on SPY. The expected decline is underway. For how long and how deep? And what's coming after the drop?
Well, I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market started out the week quietly awaiting the Fed, which was coming on Wednesday. It was expected the Fed would do nothing, hold interest rates at 5.25% to 5.5%, and maintain the QT program. Investors got what they expected, but the tone was much more hawkish than they did expect, as Powell said that they raised the GDP estimates for 24, that they expected employment would remain tight in 24, and they did expect one more hike here in 23, but they raised the average forecast for Fed funds for 24 from 4.6% up to 5.1%. That is much higher than the markets had expected, and the bond market didn't like it and got sold very hard. That sent the indexes down on Wednesday, with the S&Ps moving down 40 points. And that mantra, higher for longer, really bothered the market because the decline carried into Thursday with a big sell-off, and the S&P's down 72 points, the Nasdaq down 275, and this was clearly a bull buster. Gold and other commodities fell as investors sold on surging interest rates, with the 10 years moving up to as high as 4.49%. The stock market, on our analysis, we have shown that September-October was a period with a lot of downside risk. So this week's decline was no surprise. We had been showing these repeating ABC corrections, and you can look back at our past shows and see that, which now clearly has occurred once again. And there is more risk to come, and I will show you that. A little bigger picture comes from the great Edward Yardeni. Really, I've been a fan of his for a long period of time. He's worked for a long list of companies as chief analyst or their investment strategists, and for a long time at Yardeni Research. And I want to show you this slide. I think this is very important. He just recently posted this. This came out of the Federal Reserve Board also. And what you're looking at here is a slide of the major central banks versus the S&P 500. In other words, it's the assets that those central banks hold as they keep buying up all of their government securities. And of course, that is QE, quantitative easing. And what I want you to see is that we're going back here to 2008. This is the great financial crisis back here. And you can see that the red line is the stock market, and the black line or blue line is the holdings of the assets of the Fed, of the banks of the ECB, the Bank of Japan, our Fed, and that is showing you that, well, here they kind of slowed down a little bit right there in 2014-15, and of course the stock market had several declines right in there, and we call this the mini bear market that happened right in there. If you look over here where they began their QT1, as they call it, you could see the stock market had a big decline right in here, and then, of course, the pandemic. And I won't say that that's related, but the stock market certainly struggled during this period. Now, as you can see right in here, there is a very big disparity going on. Here you could see we've been in QT coming down this period. This is the holdings of all of these central banks. And at the same time, our S&P 500 has gone up here, getting not all that far from the all-time highs, with a big recovery during that period through mid-September is what we're looking at right there. This is a huge disparity. And the QT that we have seen, the reduction of assets in all of these central banks, has been counteracted by AI. So all of this reduction of holdings by these central banks, all of these thoughts that all of these companies in the tech area and this just magic 7 stocks that have held the markets up here in the U.S., just moving up to huge valuations, have defeated so far this QT that is going on here, the quantitative tightening. That is likely not going to last, as the markets are simply out of whack. And it's much more likely that what's going to happen is that when this AI craze settles down, and it may be happening already, that the market will have a more sizable correction. And I'll talk more about that later in the show. In the meantime, that is probably going to keep the market from being able to get very far. This disparity will be corrected, and these valuations are crazy. And it's not likely going to be corrected because the Fed begins to add to their sheets again, or to the balance sheet, or these other major central banks. It's just not likely to happen because they have lost credibility and they're trying to get their credibility back. So they're not likely going to restart inflation when seemingly that is calming, at least right now. So QE not coming back now, and this disparity will not be solved by the balance sheet going up. It'll more likely be solved by the S&P 500 coming down. So I just wanted to show you that. I thought that was very important to look at. There is that huge disparity going on right now. Well, stocks, they did fall hard this week, and rebounds, they're likely to come, and they have to be held in suspicion. We especially think that's the case for the next 4 to 7 weeks, where, based on our work, the market does look like it's in a dangerous time frame. And in the last several weeks, we warned you that it was the time to sell. Now, looking longer out into next spring, those are likely still going to be problems where the market will try to rally and then not be able to hold. The Fed will not be friendly to the stock market for months and months to come. And in this QT program where they are essentially draining funds from the market, that is likely to be a tough environment. So while we do expect the stocks to get a rally in November and December, get some kind of a rebound, keep this Yardeni chart in mind, because what it does warn is that when the market looks great, it'll be time to sell. For the week, stock indexes down 2 to 3%. The worst of them was the Russell, the Dow a little bit stronger. Bond market loses on the 30s about 2 points. 10-year yields up 14 basis points. They got as high as 4.49%, trading about 4.47 right now. We're doing this recording a little earlier in the day than normal. Gold market about unchanged, silver up 60 cents. Overall, that's a pretty strong market when you think that yields are going up and the dollar had moved up. That normally would be bad for the metals markets. They held on pretty well, and silver making those nice gains. The dollar up slightly. That it certainly is very strong based on these higher interest rates. And the oil market really strong, moving up again here on Friday. It made a high of 92.38, trading now over $91 here early on Friday. You can get all of our analysis on all of our commodity work and the indexes by watching the Future Speak show. Arvi does an amazing job on that every single Wednesday, so you can become a level 2, 3, or 4 member to watch that show and get all of our analysis. Make sure you go to askSlim.com, subscribe to this channel, share what you see over there with everyone you know, and make sure you follow us on YouTube or on Twitter. Those are, I should really say, X. Those are places that we post a lot. Click the notification bell on our videos and like this video. Give it a thumbs up if you are watching it on YouTube. If you're new, get acquainted with us when you go to our website. Sign up for level 1. It's only $45 for 3 months. And especially if you're interested in the stock market, you're going to get a ton of information every single day. So just level 1 is all you need to really get started with us. Any questions? Write to Matt at askSlim.com about our content, education, and analysis. This is stock sectors. Ari's going to take a look at 12 sector ETFs, doing unusual analysis using our MCI, that is the market condition indicator. Ari, show them this great indicator.
Stock sectors, sector ETFs for September 21st, 2023. This is RV Ramachandran. So in this video, what we're going to do is look at the 12 sectors of the market that we follow using just one of our studies, and that is the askSlim Market Condition Indicator, which is available for level 4 members and up. And this is a fantastic study because it uses multiple time frames to give you a single sum of the evidence reading. It'll range anywhere from minus 100, which is very bearish, to plus 100, which is very bullish. There's also something called a swing zone, which is in the range of minus 25 to plus 25. If you have an MCI reading inside of that zone, that is a neutral condition. Okay, so let's go ahead and jump in. We will look at 12 sectors of the market using the MCI. And this is our grid using Thinkorswim. And you'll see the askSlim MCI here right there on each of those charts. And what you'll see with this grid, which I can share with level 4 members and up at askSlim, is a very quick reading in terms of what sectors of the market are bearish and which ones are not. And if we very quickly run through this, we see that the XHB is minus 98. That is very bearish. You'll see that the XLI is minus 100. That's also bearish. You'll see that the XLB is minus 100. That's bearish. You'll see that the XLV is minus 76. Also bearish. XBI minus 100. XLP minus 87. XLU less bearish, minus 37. One thing to watch here, if you see that the MCI is actually moving up to the base of that swing zone, we now have to watch for a failure in price versus that 65 area, and you can see it is failing versus that level. So if you see the MCI come to the base of the swing zone, you would watch for a failure in price. Conversely, if you see the MCI coming off of the top as it is doing right now, and it holds the swing zone, you would then watch for price to actually turn back to the upside after that, if the MCI can hold the top of the swing zone. So that's something that you do want to watch quite closely. But right now we're seeing a failure in the XLU at the base of the swing zone, and we are turning down sharply. If you shift over now to the XLF, this is not bearish. We have a 48 reading, which is actually a positive reading still in the XLF. Let's go ahead and move over to the XRT. That's minus 100. That's very bearish. Shift over to the XLC. We are now at plus 28, very close to that swing zone and likely to move into it. So heading into a neutral condition. Shift over to the XLK, minus 80. That is very bearish. And also now shift over to the XLE. This is plus 67, and that's actually a positive reading. So just using this one indicator, you can see that the only sectors that are still positive are the XLF and the XLE. None of the other sectors of the market are positive right now, and that is why we are seeing so much weakness in the market, is that we don't have a lot of groups to really lead us on the upside. The MCI uses multiple time frames to give you that some of the evidence condition and properly weights the longer term trend. So as you see the MCI turn down, that is giving you important information about weakening that's happening in that longer term trend. So it is really a very key aspect of what we do and one of the core tools that I always keep on my charts all day long. If you have any questions, feel free to send me an email, and you can also post it here in YouTube, and happy to answer that for you. Thanks again, and I hope you guys have a great day.
Love that. Super work, Harvey. And this is now Katie, trade planning with options. Katie's going to share a bullish options trade in crude oil. She will share the analysis that we do and combining cycle analysis with these option strategies using the Tasty Trade platform. And she's going to show you how you can open up an account at Tasty Trade, and we get credit for that, and you're going to get a nice bonus for signing up there. So go to our website to the top, as Katie shows you, and open up a Tasty Trade account. Katie, show them the work.
This is Katie with askSlim, and this is Trade Planning with Options on September 20th, 2023. Today we're going to look at a trade idea in crude oil futures. First, our legal disclaimer: the options trades that I demo and follow up on are trade ideas. When I talk about closing, adjusting, or managing them, I'm educating around management techniques, best practices, theories around risk management and profit taking, and highlighting aspects of options trading that we encounter as we follow the trade ideas. This disclaimer is specifically related to options trading. For full legal information, please go to the askSlim website or email Matt at askSlim.com. Let's get started. This is the weekly chart of light crude futures, and the first thing I want to call your attention to is this very large 78-bar dominant cycle. It is broken into minor thirds, and those minor thirds are also further broken down into minor half cycles. So these are harmonic families. Now we likely formed an early low on this first minor third cycle right here 4 weeks ago. However, we are still in the weekly cycle timing window shown by these blue vertical dashed lines, and that is a period of risk. So that is certainly something to be aware of. Now, momentum has been and remains positive with a green reversal scout, our proprietary momentum indicator, this green and purple ribbon on the chart. Notice how it's almost acting like support. Switching over to the daily chart, on this chart we have a 36-bar dominant cycle that is broken into minor halves. Now we are currently in the minor cycle timing window when we expect a minor cycle low to form and then move up into the rising phase of that second minor half cycle. Notice the extreme positive conditions in here, hardly a downtick. Momentum is positive with both the green reversal scout and also the slim ribbon is positive. It colors the candles red, green, or gray depending on momentum conditions. And as you can see, it has been and remains positive. Now we did get down into the slim ribbon today. The middle of that acted as support, and now getting a momentum continuation to the upside signal on the slim ribbon PO. We are projecting to that $94 to $95 area in that early to mid-October timeframe. We're going to go over to Tasty Trade. They are our preferred options trading platform. You can hover over the Marketing Partners tab and click on Tasty Trade on the askSlim homepage. That will take you to a page where you can open an account with them. Doing so through our link helps you with some special bonuses and also helps us. Let's now switch over to Tasty Trade. I have crude oil futures loaded in here. Symbol is /CL. The IV rank is 13.8 with implied volatilities in these expiration cycles generally in the 30s. This IV makes both short and long premium trade ideas appropriate in here. I'm going to set up a bullish long premium trade idea, and I'm going to use the October 9th expiration cycle because that aligns with the time period when we expect crude oil futures to have made a second minor as well as dominant cycle peak. Now I'm going to demonstrate a call debit spread. That's a bullish trade. To set it up, we buy an in-the-money call. Let's buy that 90 call. And then we're going to sell an out-of-the-money call to reduce our cost basis. Let's sell the 91 call. So this is a $1 wide call debit spread, but the notional on crude oil futures is 1,000. So a $1 wide debit spread is actually worth $1,000. We are paying a debit of 50 cents multiplied by 1,000. It's $500. That is our max loss. And max profit is the difference between what the spread is worth and the debit paid. So in this case, $1,000 spread minus $500 is also $500. So max profit 500, max loss 500, and that's also our capital requirement to place the trade. Now let's take a look at the risk graph. Our profit zone is in green, our loss zone is in red. Where crude oil is trading right now is shown on Tasty Trade by this small red flag. So what we want is for crude oil futures to move up from the current price. Now that is our options trade idea today. We will follow up on this trade idea next week. As always, please feel free to reach out on Discord or via email to katie@askSlim.com if you have any questions or feedback.
Love it, Katie. Absolutely great. This is our top tier level 4 special trial for first-time subscribers and upgrades. For 1 month, this is a one-time use, so this is important. You can get everything that we do. This is a great way to learn our analysis for just $99 for the first month, 37% off our regular $159 a month. And with that, you're going to get our new market condition monitor, the premium version of that, which I'll give you a little look at in just a couple of minutes. So please do sign up for level 4. You're going to get everything on this page and so much more. Besides the market condition monitor, you're going to get everything that we include in levels 3, 2, and 1. Go to askSlim.com to the top of the front page, click the Learn More button, and you will see full details on everything you're going to get. Just $99 for the first month that you sign up with us. This will be amazing. And again, this is how you begin to learn the type of analysis that we do and what actually called for the stock market decline that is going on right now. So please go to our website, top of the page, click Learn More, and any questions you have after that, write to Matt at askSlim.com. Stock market analysis and projections on the S&P 500. First, important information. Do read this slide. It shows you what our approach is to the markets and our analysis and what that means for you as you begin to apply it to your own work. Stock market, S&P 500. I'm going to look at the SPY weekly and daily cycle analysis and give you a peek at our market condition monitor. And I think you're going to just absolutely love the work. So let's take a look here as we switch over to the SPY chart. On the left here, you can see the weekly chart. On the right is the daily. We call this our side by side. Let's open up this weekly chart right here, and you will see the cycle analysis. For those of you that are brand new, on the bottom are cycle brackets. These express the ideal harmonics in the market. In other words, the heartbeat of the market, the way the market moves as money flows in and money flows out. We have our other proprietary indicators on here and some other work where we show support, resistance, and the momentum conditions. As you could see, this is our reversal scout. You could see during this period right over here, April, May, June, July, this was positive, and you could see that the momentum was really strong. Here's where it turned down. Now, these yellow ovals are where the periods of risk are. Now, I had talked about for the last month the likelihood of a repeat of these ABC corrections that you see right here, ABC, saying that that was likely to happen right there. And you can see, well, that analysis came to fruition as the market has moved down here. So right now we're in this period of risk where the minor cycle and the dominant cycle show outflows of money. That is where you get the corrective periods. And the supports come in right over here. So that support is right around 429 on the SPY, and then here at about 419, and then all the way down here at about 410. I would say that that's an extreme. There are still several weeks left to go before this corrective period is over. This decline here aligns with the daily cycle, which I'll show you, which comes out into late October. That's why you see these two vertical lines. This is the normal range of where the trough would be, the bottom of the decline. This extends a little bit further past that timing. And the reason for that is because what I'm going to show you on the daily chart. So this worked out exactly as expected. You can see the cycle rhythms in here, the dominant cycle, and then the two half cycles that you can see, 1, 2, 1 and 2, and this extending down over here into November. I want you to go to askSlim.com to the front page, click on workshops, and watch the free video if you've never seen our work, and you'll be able to start to understand our style of analysis and what really helps us to get a high probability in projecting both in price and time. And we are some of the rare analysts out there that do project out in time. So I want you to start to learn about cycle analysis. Now, after this decline period is over, we get into these rising phases, as you can see right over here. And that tells you that after that's over, you're likely to get a rally. Now, the rally could get as high as the last high right there into towards the end of the year. It could get beyond that if it got very strong, but based on what I showed earlier in the show with the conditions of the Fed pulling money out and a big disparity between the central bank holdings and the fact that we are in quantitative tightening right now, and the level of the stock market, which has gotten very out of whack. That says that it's not likely that you're going to get beyond this level in the next rally and may fall short of it later out into the year. And that would make this a selling opportunity because this comes out into the late winter, early spring, which could be another period of serious decline in the stock market. So we're concerned about this as a period of risk and believe this would be a selling opportunity right here. Let's take a look at the daily chart here, and you can see here the big cycle harmonic. That low points to out around October 30th, so that's the alignment. Now what you're seeing here is the minor cycles and how that resolves up on the top. This is the slim ribbon. This is our momentum indicator that I like to use on the daily chart, and on the bottom the slim ribbon PO. When it's green, it's positive, and these arrows show you momentum resumptions. Here it tried to get to the upside but then neutralized and now has gone negative again. Now what I want to show are the projections right in here. Now there are 3 tracks of projections and they're all really negative. The best one is coming up here and testing the 78.6%, which is very unlikely. Originally, back in this cycle, we said that 78.6% was a repair level, and if it closed above that, we would have to look hard at redoing our analysis and see what had changed. Well, it failed right over there perfectly, and then you could see began to come down here. Now, you see this low here and this low here. So far, this is below, and of course, it will remain below as far as the completion of this cycle goes, which says that it's very likely the next rally will fail in these resistance areas. The bold one with the arrows is the highest probability track. In other words, coming up here to the bottom 38.2 and then coming down over here and finding the supports around that 419 to 410 area down here. We had upgraded that, but then when this turns into a negatively configured cycle, it then warns us that yes, the worst case is it could get down here to about 410, which is very possible. Maybe getting down here to 420 is more likely, but 420, 410, that is really the range of our targets here out towards the end of October. The only way to change that would be if it was so strong that it got over that 78.6 there at 449, Now that's of course a little lower than it was over here because of this change of the depth of this decline, but that would then tell us that the strength of this big downward turn that you see right over here is not all that strong on the downside. So it would tell us to put a higher track in there and to expect less of a corrective period out here. But right now, the highest probability is that this will make some kind of a bottom right in here in these next couple days, rally out for some week or so, and then come down again. One more thing I want to show you here is a quick look at the VIX, VIX. We're going to look at how these cycles in the VIX suggested that the market had gotten too complacent. Here you can see right in here where that trough was supposed to be, as it made a low of 12.68 on implied volatilities. And that is a very, very complacent level. You can see anytime it got over there, the implied volatility started to go up again. And in this case, we expect IVs to get up much higher. Now, I'm only showing a test of this level right over here, but implied volatilities could easily get much higher there. If you look at the weekly, here you can see that this is the area we expected implied volatilities to bottom, synchronizing with the daily chart. I'll show you both of those charts side by side right here, and you can see that both of those lows came on the same timing, and that is what happens when the market begins to top and set up for a significant decline. I would not be a bit surprised to see mid-20s in implied volatilities out here into that October period. Actually, this could actually be drawn much steeper. Like this out into that late October period, and maybe even get up into the 30s up there. So we don't really know. It depends on how hard the market gets sold, but it is likely that we're in a period of rising implied volatilities. And of course, on up days when the market tries to rally, IVs pull down, as you see happening here on Friday, but that's not likely to hold. And I think that this is indicating to us that the market does have a pretty sizable decline still to come out into that period of risk here out into late October. So rally days are to be held in suspicion, and we believe that that is the conditions that we have right now with a decline out into October. Again, go to askSlim.com, watch the free video in the cycle analysis workshop, and watch for a special we have coming up soon in the cycle analysis workshop. If you want to get kind of locked in on that, write to Matt at askSlim.com. Tell him you're interested on the special in the cycle analysis workshop. Here is our market condition monitor, and this is just an amazing app. Now, I showed you how level 4, if you sign up for level 4, you can get this premium app right here, and you can see the conditions right now. I'm looking at the short term there, which is for those of you that are swing traders, option traders, you're going to want to see that, and you can see the conditions right in here. IWM turned from slightly bearish. They all turned from slightly bearish in the last 2 weeks to bearish, as you can see in here, and that is for the short term. So we're projecting that it's going to really struggle for a number of weeks here. IWM turned bearish back on September 15th, so that was the leader, as you can see in there. So these conditions, these momentum conditions, are quite negative looking in that at the stock market. We have more than 115 of the widely held stocks and ETFs in this great app that you can see here. So if I take a look here at from short term to intermediate term, looking a little bit further out, you can see that these have turned to bearish to slightly bearish, though the QQQ, because it still has some positive readings on momentum and longer time frames, it is neutral. That is likely going to turn worse, but we have had some downturns from neutral to bearish and slightly bearish in the last couple of weeks here, even on the longer term. So this is not giving a great signal for the long term. And we have also what we call near term for short term swing traders and intraday information on there also if you want to become a level 4 member and get this app. So just a fantastic app, and you can look at trade setup conditions from what is very bullish to what is very bearish, as you could see right in here. And very bullish we still see is EWJ, KEI, Tesla, and India, which has been very bullish. And here, if I go to very bearish, it's SIL, which is the silver miners, natural gas, PayPal, still very bearish, and LIT. So that's just the top four on both of those. Just a great way for you to understand the conditions of the market using this just unique app that we have developed, the askSlim Market Condition Monitor. That's it. That's our look at the stock market. I hope it was extremely informative to you, and that you do take advantage of the specials that we are running. You can get this level 4 top tier special for just $99 for the first month. You will get everything that we put out there. So many lessons, more than 600 videos that we have produced on 12 different categories, including trader psychology and tools for techs, where I did 80 different videos on using different tech tools. There's so much I can't even tell you. So go to the askSlim website, click Learn More at the top of the front page, and that will give you a lot of the information, or write to Matt at askSlim.com. I want you to explore our website. If you're new, get acquainted, become a level 1 member. On YouTube, subscribe to our channel, click the notification bell, and do like this video, give it a thumbs up, and watch our videos in the playlists. On X, follow us at askSlim, and any questions you have, write to Matt at askSlim.com. I want you to be so careful. It is so crazy out there, and I'm always wishing you great trading.
Well, I'm going to say